In this kind of a scenario, mutual fund is a discovered asset.
My most frequently answered way has been that it is futile to predict markets in the short run. In this context, my sense is it's not just the Indian government challenge, it is a challenge globally, but it hurts us more because we need to provide those jobs. So some of the best performing stocks in the US are trading at
Welcome to Method to Madness. In this podcast, we are going to cover one of the very special topic, and we have a special guest today. So, we have invited him all the way from Bombay to here, and he didn't hesitate to come here, and that shows his commitment towards what he wants to do. So, he's none other than Pramod Gubbi, and he's a founding partner in Marcellus, and he currently heads the client advisory and relationships. And he's an integral part of the investment committee. He was former MD and head of institutional sales in Ambit Capital, and he's an alumnus of IM and NIT, and he's a CFA charter holder. And Mr. Pramod is known for his thoughtful commentary on markets themes. He advocates disciplined investing through uncertainty on long term, right? So we have Pramod today. Hi, Pramod.
No, thank you. Thanks for having me here. It's a pleasure. It's my honor. Thanks for the opportunity.
Yeah. Pramod, in fact, we thought that, today we'll speak a bit more about how the investment frameworks in the investment fraternity are changing, and, what are the opportunities for the clients they are having in today. Because probably, if you just look back 10 years back, the equity AUM was somewhere around, in mutual funds, equity AUM was somewhere around 2 lakh crores. And currently it is skyrocketed to a very large number. And a largest AMC manages 5 lakh crore, right? So in this kind of a scenario, mutual fund is a discovered asset. And today, to an extent, the scale of wealth what people have made has gone up. So, if we have to count a client with $1 million portfolio, we could have a handful of clients, right? So in this kind of a scenario, when we come into asset allocation, are we going and buying a same product, right? Are we going on same asset itself? So it's not a true diversification. So when we were just analyzing on which are the products we are underweight, which are the products we are overweight, we thought that, international is one area where investors are underweight, right? So in this podcast, we thought that, we'll hear it from horse's mouth, and to understand the nitty-gritty and other things in this particular product as a category, right? So before that, probably, anyways, you are here. You're known for giving a broad view on the markets. So we want to hear from you about what is the India view, how India markets are placed. Currently, we have a rich valuations. So how do you see India market, and how do you see what is the potential for investors to help in their wealth creation?
Right. Yeah, look, this is the most frequently asked question, and my most frequently answered way has been that it is futile to predict markets in the short run. So whatever I say, it will be with the long term in mind. India has been one of the best performing markets globally after the US, giving roughly double-digit return in terms of dollar terms. I reckon going forward as well, we should expect pretty similar returns. The challenge has been expectations. Expectations over the last 4 years, given the returns over the last 4 years are pretty high. Most people have got about 20% compounded returns, and they come into the market with those expectations. That's where I'm sounding cautious. I'm telling people that yes, the Indian economy from a long-term macroeconomic perspective remains on strong footing, and therefore you can expect reasonable returns in the long run, except you will have to temper your returns. I reckon achieving a 10-12% rupee return in the next 5 years shouldn't be a challenge. Of course, there are headwinds from a shorter term perspective. both in terms of slowing down of public capex, which was one of the big drivers of economic growth post-COVID. And secondly, revenge spending from the consumer also held up pretty strongly. So the economic growth benefited from it. At the same time, earnings of several companies grew pretty strongly. And around COVID, valuations were a lot more reasonable. So therefore, you had multiple drivers in terms of stock price returns, which is why you're seeing that 20%. Now, if you look at those drivers as of today, the government is clearly on a fiscal consolidation path, and therefore public capex or government capex spending is slowing down quite significantly. The consumer having spent on revenge spending, sometimes on borrowed money. You've heard the RBI talking about excessive risk in terms of personal loans and unsecured loans. There's been a crackdown on it. You've seen early signs of NPAs coming through on unsecured loans. Microfinance went through a brutal asset quality cycle. We've seen MSMEs and credit cards as well showing up. So which means that the consumer is also stretched a bit. It's unlikely that the consumer will continue to spend the way he or she did to sustain the economy. So if government capex is slowing down, private consumption is slowing down. So the only bucket that's left is private sector capex. This has been the biggest anomaly. Private sector capex, we've been hoping for a long time will take off. For some reason, it hasn't taken off the way we would have expected. Partly driven by external uncertainties. We've had geopolitical issues. We've had the tariff issues, trade issues. So which is a bit understandable, but corporates have deleveraged quite significantly. Their balance sheets are pretty strong to invest. The banking system still is in pink of health in terms of its ability to provide credit. The RBI has cut interest rates, then there's plenty of liquidity available in the system. So we're hoping that the private sector capex is going to take the baton over and will drive a recovery of sorts. Unfortunately, we've had this sort of a headwind coming from global tariffs, which means that we'll have to wait for that. In this context, two of those big drivers are gone. Valuations aren't particularly attractive. We are trading significantly higher than historical averages across large cap, small and mid cap, more so in small and mid cap, which has driven a lot of the rally. And earnings growth, now we've had almost single digit earnings growth for 4 or 5 quarters in a row. At some stage, there will be a statistical recovery. Base effects will come in handy. But if you've seen, most of the levers have been pulled, particularly in a scenario with pretty modest volume growth. Earnings have exceeded volume growth simply because corporates and companies have managed to expand their margins. But margin expansion as a driver of earnings growth is limited in terms of its potential. So at some stage, we'll need to have animal spirits coming back, private capex taking off, which in turn boosts job creation. Job creation will result in income generation, and hopefully consumption will come back. That's the cyclical part of it. But there's also a structural headwind in the form of automation across industries, and more recently AI hurting services. And services is a large part of our economy. And this is resulting in significant challenges to job creation. And for a country like ours, which was touting the demographic dividend, we have a lot of young people joining the workforce, which was supposed to be the biggest macro tailwind for us. Suddenly in the world with automation and AI, it's turning out to be a bit of a headwind. In fact, for the West, which has fewer and fewer people with population declining, maybe automation and AI is actually beneficial because you can deliver similar economic output with fewer people. Unfortunately, we have the big task of creating jobs for the millions of our young people joining the workforce. And this sort of headwind is not particularly great. So I won't envy the government job because it is a big challenge. It's not just the Indian government challenge, it is a challenge globally, but it hurts us more because we need to provide those jobs to people. So in this context, my sense is unless and until we see significant reforms or boost to the economy, which can create earnings recovery or a significant correction in the market, which makes valuations attractive, we would be quite circumspect on Indian markets returns, at least with these starting point valuations. And we haven't even talked about the impact on the export sector from these incremental tariffs. I'm not dwelling too much on it because I'm hoping at least the second 25% tariff can be rolled back sometime soon. And I hope that will not have a detrimental impact or a further impact in terms of job losses in our export-oriented sectors.
Got it. So thanks, Pramod. We have briefly addressed on, what are the bottlenecks. India has seen a fantastic 4 good years of rally. Obviously, when you look at a portfolio, you are at 20% or at 25%, and investor expectation also has gone up. Okay, but if you just dive deep and look at the data on a 10-year rolling or a 20-year rolling, or if you look at for past 30 years, a 12 to 14 is a number where India has delivered. Obviously, a 20 has been front-ended, so probably we might see a pause for a year or a two. Might be, as you rightly said, it doesn't stop an investor, to go back to other places and see where their opportunities are. So you were speaking about the Western is enjoying the AI side, right? Because demographical is something which we had been betting big time, right? So I think AI is something squeezing that part. So keeping that in mind, US has been firing. The entire AI story is being captured by US. And what is your view on US as a market and as an opportunity for investors? How do you see?
Yeah, so look, US has been the best performing market in the world for the last 10, 20, 30 years. Only India comes close to it. Now, this is where people are surprised that India is growing its economy by 6 to 7% in terms of real terms, whereas US is only 2 to 3%. China has grown at 10% for the last 20 years. Yet, how is US the best performing market? This is the biggest myth that people often tend to believe that economic growth results in stock price returns. In fact, there is plenty of literature which suggests that there is very little or almost no correlation between economic growth and stock market returns. In fact, China being a case in point, 20 years of 10% growth, but very little to show in terms of stock market returns at 5%. US, on the other hand, 2 to 3% of economic growth has delivered 10% dollar returns for long periods of time. The key to understand why are US and India stand out amongst large global markets. The two commonalities between US and India have been both are democracies and both are free markets. Unlike China, where you have these issues, which means that market forces eventually drive any excesses in the economy, more importantly, drive efficient capital allocation in the economy. That's where private capital or shareholders of companies tend to generate significant returns. And US is the best example of that. At the same time, this also creates a very conducive environment for innovation. Talk about the most innovative companies in the world today. You talked about AI. OpenAI, the largest generative AI company today, comes from the US. The biggest data center companies or hyperscalers, whether it's Amazon, Microsoft, Google, all happen to be from the US. Until recently, the largest electric car company, Tesla, was from the US. So the market-driven economy drives innovation, which in turn drives shareholder returns. Which is where the global competitiveness comes into play. None of that is under question, if at all US continues to run ahead on that parameter. Having said that, from a value investor's perspective, everything needs to be seen in the context of valuation. If investing was all about buying great businesses and forgetting about them, it would have been very easy. What we've learned, from the likes of Buffett and so on, is even great businesses need to be bought at a reasonable price. So some of the best performing stocks in the US are trading at reasonably high multiples. I wouldn't say that they are excessive like we saw in the dot-com boom, because unlike the dot-com boom where everything was based on the future, many of these tech companies are actually generating profits today. They're generating free cash flows today. Phenomenal amount of profit margin expansion, free cash flow margin expansion. Having said that, the question is, are these sort of free cash flow growths sustainable into the future? Given the very nature of technology and innovation, they are very prone to disruption. So what we are saying is much of the tech valuations today are not factoring in disruption risk. For all we know, we could be wrong and they can continue to dominate. But from a value investing perspective, like Buffett has said, the most important chapter in intelligent investor is margin of safety. Are we seeing the margin of safety in US tech? Not so much. However, US is a much more diversified economy than just tech, right? While all our attention goes towards tech, because tech has driven most of the returns in the US over the last several years. But US being a very dynamic economy has had various drivers of economic growth across industrials, healthcare, financials, and so on, which means that if you look beneath the hood of the Magnificent Seven, there are some wonderful businesses which are available at very attractive valuations. So it was easy to make money in the last few years by just buying a S&P 500 ETF or a NASDAQ ETF. But I reckon the next few years, you need to be a lot more discerning and selective. Those who can go beyond tech will be able to find significant opportunity to deliver good returns by finding quality businesses at attractive valuations.
Yeah, Pramod, one thing, as you rightly said, US is growing at 2-3%. And that's not reflecting anywhere on the markets. If you look at the S&P numbers, the street expectation was 7-8%, but they clocked almost 11%. And 80% of the entire revenue came from Big Seven. So the entire AI, basically they are capturing the entire global story in the Big Seven. But the US story is being captured in the bottom portion. As you rightly said, it is not like buying a right idea and sitting over it, doesn't make big money. Because, one stock which we had worked very closely was Walmart. First 20 years, it fired. If someone could have bought at 20th year, maybe from there, it has been a very significant lower growth on the Walmart, right? It's a very, very valid point from your side on the US markets and the current valuations.
Speaking about Walmart, we had a stock called Costco, which is in the same business, right? It is retail, consumer retail, which has done phenomenally well for us. In fact, we had to book some profits last year because we were getting a bit uncomfortable in terms of valuations. But yeah, so that's the point, that at the end of the day, when we invest, we don't invest in an economy. We invest in a business. The business operates in a certain environment. A lot of US companies are actually doing bulk of the business outside the US. So what happens to the US economy has very little consequence on it. Even if the US economy were to be slow and affected, we've seen good businesses actually tend to continue to deliver because an adverse macroeconomic environment actually favors the big and the strong. Right? The weaker companies tend to vacate during that period, and that's actually a great time for great businesses to continue to grow, even in a weak environment, by simply taking market share from those who fell by the wayside. If you remember, even in India during 2011, 12, 13, in a very weak economic environment, there were stocks like TCS and Sun Pharma and Asian Paints and HDFC Bank, which did phenomenally well. So at the end of the day, from an investor's perspective, the macro is just one factor. The micro is actually far more important. And arguably, a weak macro creates a positive macro as capital cycle returns. Weaker companies exit the sector. That leaves market shares to be gained for the stronger ones. Returns on capital improve, margins improve, pricing power comes back, and that's where earnings growth comes through. And the bottom line is stock prices in the long run are driven by earnings growth and not GDP growth.
Very true. Thanks for that very brief context.
Depending on the performance of these specific 10, 20 companies, you could be doing significantly better than the index or significantly worse than the index. Like you talked about, I carry an iPhone. This is made by Apple. I go home and watch Netflix, which is not listed here. I do most of my searching on the internet through Google. Questions. Not to say that Indian companies are bad or something.